If you sit down with a financial planner and run your retirement numbers through their software, or you're a DIY running the figures through software like Bolden, there's a very good chance the software is going to give you one specific piece of advice: convert your traditional IRA to a Roth. The software will show you beautiful charts with massive tax savings projected out over 30 years. But when you look closely at those numbers, the actual break-even point, the moment you finally come out ahead, is often not until your mid-80s. So today I want to walk you through what the software is actually assuming and introduce an alternative strategy that a lot of retirees don't hear about. Welcome to Retirement Guide. I'm George Jameson, a CFP and RICP, and founder of Capital Wealth Group, a fee-only firm based in Columbia, South Carolina. We offer ongoing retirement planning and investment management, as well as one-time financial plans for do-it-yourselfers. Thank you for joining me. Why the software loves Roth conversions. To understand this, we have to look at how financial planning software is built. And I want to be clear, a lot of good advisors are recommending Roth conversions right now. And in many cases, it's the right call. But in some cases, I think what's really happening is the software is driving the recommendation. The advisor or the do-it-yourselfer runs the numbers. The software says convert, and that becomes the advice, without stepping back to ask whether those assumptions behind the recommendation actually match what the client wants. Most software has one primary objective: maximize your total net worth at the end of life expectancy, which is usually set to age 90 or 95. So mathematically, if the computer assumes you're going to live another 30 years, leaving money alone to compound completely tax-free inside a Roth IRA will almost always produce a higher final number on paper. But here's the thing. The software is usually relying on two specific assumptions to make that conversion look so attractive. First, it factors in your after-tax and non-retirement assets as a potential source to cover the upfront tax bill. Most planners, myself included, will model the conversion using those outside funds to pay the taxes, because pulling money from the IRA itself to cover the tax generally works against you. But even if you do have that outside money available, there's a real question worth asking. Do you want to hand that money to the IRS now, or use it to fund your life during the go-go years, the early years of retirement, when you're most likely to travel, spend, and enjoy yourself? The software can model that trade-off, but it doesn't always surface that question on its own. And then second, it assumes your primary goal is wealth preservation or leaving a legacy, not spending your money and enjoying your retirement. One alternative is systematic withdrawals. So what if your goal isn't to leave the largest possible balance at age 95? What if your goal is to efficiently spend what you saved? This is where a systematic withdrawal strategy can make a lot of sense. Instead of doing a Roth conversion, you intentionally withdraw money from your traditional IRA during your early retirement years, say from age 62 to 75. You pay ordinary income tax on those distributions, but you're filling up the lower tax brackets, the 10 and 12% brackets, and you're using that cash to fund your life, travel, health care, whatever your retirement looks like. For 2026, the 12% bracket for a married couple filing jointly goes up to $100,800 in taxable income. And keep in mind, the standard deduction for married couples is $32,200. So you actually have a fairly wide window to pull from a traditional IRA before you move into the 22% bracket. This approach does two things the software doesn't always highlight. First, it keeps your liquidity intact. You're not writing a large check to the IRS up front. You're spreading the tax cost over years, using money you were going to spend anyway. And second, it naturally diffuses the RMD problem by proactively drawing down your traditional IRA balance in your early retirement years. You're shrinking the account, of course. So by the time the government requires you to start taking required minimum distributions, which is now age 73 for most people, and age 75 if you were born in 1960 or later. Your remaining balance is smaller, and your mandatory distributions are much more manageable. That's the RMD bomb a lot of retirees don't see coming. If you leave a large pre-tax IRA alone for 10 or 15 years into retirement, it can grow to the point where your RMDs push you into a higher bracket and trigger more of your Social Security to be taxable, and it also may affect your Medicare premiums. So systematic withdrawals early on can take a lot of that pressure off. So when does a Roth conversion still make sense? Roth conversions aren't the wrong answer. In fact, for the right person, they're a great strategy. If your priority is long-term wealth preservation, leaving a tax-free inheritance to your children, or you genuinely expect to be in a higher tax bracket later in retirement, the software is pointing you in the right direction. Conversions also make particular sense in the gap years, the period between when you retire and when Social Security or RMDs kick in. If your income drops significantly in those years, that's often the ideal window to convert at a low tax cost. Another opportune time is after a major bear market. When your IRA balance has dropped significantly, you can convert more shares at a lower value, meaning you pay taxes on a smaller amount today, and all the recovery and future growth happens inside the Roth tax-free. And here's something a lot of people don't realize. You don't have to sell anything to do a conversion. You can transfer funds, ETFs, or individual stocks directly from your traditional IRA to your Roth IRA in kind. The assets just move over, and you pay taxes on the value at the time of the conversion. If you do have cash to cover the tax bill, the math improves considerably. So the bottom line, neither strategy is universally right or wrong. It depends entirely on what you want your money to do. If your priority is cash flow, liquidity, and efficiently spending your savings during your most active retirement years, a systematic withdrawal approach from your traditional IRA combined with withdrawals from your taxable accounts can be a tax-efficient way to smooth out your lifetime tax bill without the upfront hit of a conversion. If your priority is maximizing what you leave behind and you have the resources to pay the taxes without touching the IRA, a Roth conversion may be hard to beat. The key is to look past the default software recommendation and make sure your strategy actually matches your retirement goals. That's where a fee-only planner and professional planning software can really make a difference. Not just running the numbers, but making sure the right question is being answered. Thanks for joining me today on your Retirement Guide. I'm George Jameson with Capital Wealth Group. If you found this helpful, please subscribe and share your thoughts in the comments. And if you'd like a free retirement review, visit us at capitalwealthgroupsc.com to schedule a no-obligation call. Have a great day.